happening at this time of year, the Santa Claus rally. Now, it sounds like it's a goofy title, but it really does exist. Okay, I can give you all the statistics and all the information, but there's reasons why certain things happen this time of year. If it was another time of year, we'd call it seasonality. But since 1969, 34 of the 45 years have seen a late December rally. So I'm going to give you 5 reasons why the Santa Claus rally might not happen this year. Okay, but it's still something to watch for. Now, even though the major rally happens in the U.S. stock market, and you say, I'm sitting here in the UK, or I'm sitting here in Spain or France or South Africa, why do I care? Well, first of all, since you're trading CFDs, you're trading on stocks from all the major markets. That means you can trade indices or stocks that are affected by the U.S. market. But the U.S. market isn't independent. And the U.S. market also has an effect on the dollar, which has an effect on the euro, which has an effect on gold, which has an effect on Bitcoin. So there is a ripple effect. And you should understand all the time what is happening in the marketplaces. Now, this year, vaccine optimism combined with new stimulus seems to be poised to once again jingle Wall Street's bells. So we're all sitting there. What do we see in the headlines every day? Vaccine, vaccine, vaccine. A lot of countries like the UK have already started it. More countries are expecting, to approve it shortly. And we're all hoping, against time and hope, that by spring we have the virus under control. Okay. So that gives us a lot of optimism. We also are expecting, possibly before Mr. Trump leaves office, a big stimulus package. As we get closer and closer, they're going back and forth. We don't seem to be getting it, but there are everyday possibilities. That stimulus package will be a boom for the U.S. stock markets. So a piece in Bloomberg, however, provided 5 charts on the reasons why market rallies is already overbought and overblown. So this year, we might get more coal than eggnog. Historically, owning stocks in December has been a smart bet because of year-end bonuses, retirement contributions, and portfolio rebalancing. This is particularly true between Christmas and New Year's Eve. A period so strong, investors now grow to expect a Santa Claus rally. So far, the market is rallying in line with seasonal strength, but warning signals are flashing, suggesting investors ought to be prepared for a pullback, even if it's uncertain. Now, over the past century, there have been 9 holidays during which the exchanges have traditionally been closed. Historical research shows that stock prices often behave in a specific manner in each of the 2 trading days preceding these holidays. By becoming aware of this behavior, many short-term traders and long-term investors can benefit. Now, the general strategy is to purchase equities 1 or 2 days prior to the holiday. And we're talking about the Christmas holiday or the New Year's holiday, whichever you would choose. Short-term traders would look to sell just after the holiday, while longer-term traders would wait until year-end. Both strategies have proven to be profitable plays. The theory behind this effect is that traders are lightening up their holdings prior to the 3-day holiday. So many investors, many day traders, many people who just make money in the markets even as a sideline, when they're getting ready for the Christmas holidays, close out most of their open trades because they don't want to stress out over the holidays. And it's a long period and a lot of things can happen, politically, economically, and they will sell to lighten up their positions before this 3-day holiday. Then you have a huge amount of people that maybe not this year is significant, but are on holiday from Christmas or the day before Christmas all the way through New Year's. Don't come back until the first Monday after the New Year's or the first business day after the New Year's. So the selling pressure drives stock prices down, making those days a good opportunity for buying lower in the range. Now we can see on my little chart here what effect we've had the 2 days prior to any U.S. holiday that's a no, not a bank holiday, but a government holiday where the markets are closed. And what we see at the end. Okay, a Santa Claus rally is a surge in the price of stocks that often occurs in the week between Christmas and New Year's. There are numerous explanations for the Santa Claus rally phenomenon, including tax considerations. Now, these tax considerations don't flow over to European markets, but the change in the U.S. markets do. But in the U.S., you have huge amounts of people, huge amounts of hedge fund money managers and businesses that are looking at the end of the year taxes. So there's people who sell at the end of the year only with the intention to buy back in the beginning of the year, and they just flip their stock. But if there's say the stock is in a losing position, okay, it's not going to go any lower for them, so they'll sell it now, take the loss, and take it on this year's books, only to buy it back because they were sure that stock would escalate, sometime in 2021. Then you have also a lot of people who got Christmas bonuses, and again this year we're not so sure about that, but we're talking about sizable bonuses, who in fact are buying up cheap investments, not trading, but they're buying up cheap investments because they're putting their bonuses into their retirement portfolios or stock portfolios. And the fact that the pessimists are usually on vacation this week. Everything between Christmas and New Year's is always a more up mood. Now, there isn't a single cause that explains the Santa Claus rally, but experts point to several factors that tend to leave investors with a feel-good buzz. In general, the seasonal economic indicators in November and December are very strong, says Scott Colbert, chief economist at Missouri-based Commerce Trust Bank. That helps drive up investors' enthusiasm. Plus, institutional investors are making year-end trades, causing a flurry of activity in the market that can drive stock prices higher. While the Santa Claus rally can be real, noticeable effects in the market, experts say you shouldn't count on it to deliver a boost in your portfolio. So we're not looking at it as increasing your portfolio. We're looking at it as trading opportunities because we have this human effect in the markets, and we're looking for short-term trading, short-term trading benefits on these shifts. Because remember, as we lead up to Christmas and going into New Year's, there's very little economic data out there. So nothing that's really going to shape the markets. Most lawmakers around the world are on holiday. So we don't have all of that happening, but there's always a possibility of some kind of geoeconomic or political situation that can occur. But many consider the Santa Claus rally to be the result of people buying stocks in anticipation of the rise in stock prices during the month of January, otherwise known as the January effect. Now, don't get me wrong. We're big fans of seasonality. In fact, seasonality is one of the 7 inputs at our stock and sector ranking. Nevertheless, seasonal tendencies aren't guaranteed, and investors have lost money in December in the past. I mean, I can think of just a few years ago now, the Federal Reserve meets towards the end of December, and they usually, statistically, historically, everything, made no decisions. The meeting goes completely unnoticed. Okay. But a couple of years ago, we actually had an interest rate change in that December meeting, which threw the markets and the world in topsy-turvy and offered lots of crazy opportunities and volatility. So in short, there's no magic formula that works every time, and sentiment indicators are flashing warning signs. The put-call ratio near lows, and the only 22.7 of the respondents in the American Association of Individual Investor Sentiment Survey are bearish, the lowest level of pessimism in 11 years. People are optimistic in the U.S. Investors are optimistic in the U.S. So the Santa Claus rally is when the stock market rallies during the month of December, usually in the last week of the month. Sound familiar? Well, you might be thinking of the January effect, which presumably occurs when investors sell stocks in December only to buy them back in January for tax purposes. Confused yet? Well, I'll give it to you straight from Wikipedia. The January effect is a hypothesis that there is a seasonal anomaly in the financial markets when security prices increase in the month of January more than any other month. This calendar effect would create an opportunity for investors to buy stocks for lower prices before January and sell them as their value increases. Now remember, even though you're trading CFDs, you don't have to close. You can keep them open. As with all calendar effects, it is true. It would suggest that the market is not efficient, as market efficiency would suggest that this effect should disappear. The effect was first observed around 1942 by investment banker Stanley Wackel. He noted that since 1925, small stocks had outperformed the broader market in the month of January, with most of the disparity occurring before the middle of the month. It has also been noted that when combined with the 4-year presidential cycle, historically, the largest January effect occurs in 3 years, the 3rd year of the president's term. And that, if you follow politics, especially American politics, and the market combination, the reason for that 3rd year glitch is the 3rd to 4th year the current president is prepping himself for re-election in that 4th year. So they're doing everything at that point to bump up the economy. And they're going to promote the economy because if the economy is good, it's very rare that a current sitting president is voted out of office. So we won't talk about what's going to happen in January 20th in the US right now. The most common theory explaining this phenomena is that individual investors who are income tax sensitive and who disproportionately hold small stocks sell stocks for tax reasons at the end of the year, such as to claim the capital loss, and reinvest after the first of the year. Another cause is the payment of year-end bonuses in January. Some of this bonus money is used to purchase stocks, driving up prices. The January effect does not always materialize. For example, small stocks underperform large stocks in 1982, 1987, 1989, and 1990. But it's a lot of years that they didn't. So in order to claim capital losses, many investors sell stocks that have declined in value throughout the year during the last trading days of the year. If you plan on selling to book tax loss, you may consider doing it before many investors start to sell stocks en masse. So to give you a hypothetical situation, you bought Lemonade when it came out right after the IPO. Okay, but you got in a little late. You got in at 85, 90. Now, you do expect Lemonade to outperform. You do expect the markets to recover. You expect the Lemonade to be a very successful share, very successful company. But by the end of the year, this hasn't happened. But you still firmly believe in Lemonade, and you still believe it's going to happen. Well, say Lemonade, you bought Lemonade at 90, it's down to, dips down to 80. Okay. You could sell it and take your loss and say you bought 10,000 shares and took a $10 loss in each of those shares. You're taking a $10,000 loss, which comes right off your tax bill. But you still believe in Lemonade, so what you do is on January 2nd, you buy those same 1,000 shares back, or those 10,000 shares. So you had a $100,000 loss. You buy the same 10,000 shares back at the same price. And then you move forward. You have a new price book, which is the $80 a share. And if it goes up the next year, you have to worry about capital gains, but you don't have to worry about it until you sell. So if you plan on selling to book a tax loss, you may consider doing it before many investors start to sell en masse at the end of the year. Now, most of you in the audience are not from the States, but if you understand why this is happening and what causes it and why we have this December effect, you can take some type of advantage of it. So at the beginning of January, investors returned to equity markets with a vengeance, pushing up prices for mostly small caps and value stocks. Okay, according to Stocks for the Long Run by Jeremy Siegel. Okay. The average month, we'll see a return of maybe 1%. In January, we can see a return of 1.6, 1.7. Interesting, there is no agreement about when Santa Claus rallies really start, with different sources offering conflicting ideas. And it's depending on what you want to do, because traditionally the markets would be down in December and up in January. But this year, as we passed into November, and because we had a lot of excitement about a stimulus package and the potential change in parties in the U.S., as well as a potential vaccine distribution, a lot of markets have already reacted in the end of November. But we're still going to get that little push if you watch. So we decided to perform our own analysis, running the numbers over every possible combination of time periods for the FTSE and the S&P from 1986 to 2015. And we found that the biggest rise in both indices occurred from 16, 15, and 14th of December. Overall, investing from these dates brought an average return of 2.53% and a positive return of 87%. In contrast, investing over the first half of the month yielded an average loss of 0.23%. So while you can get a broad idea of when a Santa Claus rally might start by looking at historical data, each year's Santa Claus rally is very different. And it's one of the reasons I'm presenting this webinar and this time. I didn't want to present it in the 1st of December. I wanted to wait till we were 10 days out from Christmas. You can only know for sure if the Santa Claus rally has taken place once it is already over. But you can watch closely to see if Santa Claus is starting to ring his bell. So this year, December's markets are off to a good start. And remember, markets run in cycles. Sometimes they have predictability. Usually in early December, hopes turn to the prospect of the Santa Claus rally. So looks like this is happening as the indices are starting to set new records. We had huge gains in November. November catalyzed a move into cyclical and value stocks that was much more powerful and sustained than previous value rallies, with significant gains in traditional value stocks. And this is just November, what ended 2 weeks ago. However, growth, especially technology, has not seen significant selling, as many investors are still skeptical about the value rotation, while defensive and consumer products like healthcare and consumer staples have lagged, and they have produced healthy mid-single-digit gains. So, what should we look at? Well, the reopening of the world. The market is acting like the Corona-19 winter. We're entering will be a minor bump in the road to the spring reopening, and to the global reflation is now imminent. We're all hoping, against hope, that 3 months from now, all of this will be behind us and the markets will be booming, as the world gets vaccinated. Stimulus. The politics of striking a big deal before the 5th of January Senate runoff in Georgia seems increasingly remote. There is some hope that some limited stimulus may be put in a December 11th budget deal, but we don't have either of those. Well, you had a temporary budget approved, but large stimulus bills seem very remote. Reports of the weekend indicate the Senate Republicans may now pursue austerity measures in 2021. The Georgia Senate race, veteran trader Joe Zuckerman has had a profitable year, but has options covering his long positions, and has recently bought late January and late March puts. I don't think anybody is aware how critical this Georgia runoff will be. Because if we have a Democratic president and we have a Democratic-controlled Senate, and as well as a Democratic-controlled House, we might see some bills get through. If we end up with a Republican House or Republican Senate and a Democrat president, we're going to have a lot of difficulties. Okay, it'll almost be lame duck. Now, the fourth thing the factor here is the market assumption that the vaccine distribution will proceed in a smooth series of rollouts culminating in mass distribution in the early part of the second quarter of next year is also questionable. We're hoping and praying that all of this rollout goes smoothly, but it's hard to predict. A couple deaths from the vaccine, a couple bad side effects from the vaccine, some production quotas missing, but it seems like we're about to have the second and third vaccines approved in the U.S. and then they'll flow out through the rest of the world. But again, it's a gamble. So valuation growth forecasts are being lowered for the fourth quarter 2019 and for quarter one 2020. And that's off for 2020 and for quarter one of 2021. There's been little change in the past several weeks in Q4 and Q1 earnings growth for the S&P. When Santa Claus hitches up to Rudolph for his annual Christmas route this year, he may skip Wall Street, not because stocks have been naughty, but because they've been too good. At least that is the bold forecast among some analysts who believe the market has gone too far, too fast. So as you see, this is from Wall Street Journal. We can see where the market has gone to in November and December. Okay. And this is the Santa Claus rally. And historically, we can see what happens as we get close to Christmas Day. Now, know what you're doing and know the risks. The shares that I am watching closely for my personal investment. Remember, you should know the risks that you are taking. You should only make investments that you understand and decide on your own. Okay. So 3 tips for managing the Santa Claus rally. Focus on equities. While the trend may affect the Forex markets, its greatest impact historically is on equities. Monitor volatility. If volatility increases, market conditions may switch from favorable to unpredictable. Manage risk. Don't abandon your normal risk management rules just because of an increased probability of a rally. The Santa Claus rally may also act as an indicator for the year to come. They may characterize themselves as aggressive or conservative when it comes to investment risk without understanding how that pertains to their holdings. Individual traders, retail traders like us. For instance, investors think putting all their money in bonds might make them conservative. But if the interest rate rises, their bonds will surely lose value. People talk about their risk tolerance. But when you change the question to what's their loss tolerance, they answer very differently. A lot of people don't understand risk. There's a big difference between risk and loss. And like I said, they may characterize themselves as aggressive or conservative. But we have to look at our 2 sides, risk and how much loss we can tolerate. Because risk means different things to different people. Your age plays a role in the investment risk that you can tolerate and even what you should worry about. For younger investors, but many years to grow their nest egg, volatility is their concern. Older investors who are hopefully out of the money generating stage and in the preservation stage of investing have to contend with inflation and interest rates. Remember, the trading is all about risk, not profits. Know your risk and understand it before you invest or trade. Develop a risk management strategy and stick to it. Because remember, in CFDs, you can trade stocks, commodities, indices, and Forex. Too many people get so tied up in CFDs and so tied up in their local markets, they don't realize you can take advantage of these effects on the U.S. market. You can trade U.S. stocks in CFD format. You can trade U.S. indices, as well as foreign. You can trade Europeans. So if the Santa Claus effect has its predominant effect on the FTSE and the U.S. markets, why not trade U.S. stocks? Because equities and CFDs mirror each other. Because a contract for difference is a financial contract that pays the difference in the settlement price between the open and closing prices. CFDs essentially allow investors to trade the direction of securities over a very short term and are especially popular for Forex and commodities products. But this time of year, you could be using them for stocks. A contract for difference is a popular form of derivative trading. CFDs trading enables you to speculate on the rising and falling prices of fast-moving global financial markets and instruments. But you can trade shares, indices, commodities, currencies, and treasuries. Now, Avexo offers over 450 real-time assets you can trade. CFD trading mimics share trading with the exception that in a contract for difference, you don't own the underlying asset like company shares, where you do. This is why we call CFD stock market for trading. It is a great stock trading alternative. What you are essentially doing with a CFD trade is buying a contract between yourself and your CFD provider that, depending on your position, will have an entry price when entering a trade and an exit price when clearing out your trade in the opposite direction. As a rule, one CFD is equivalent to one share, except with contracts for difference, your broker will normally require you to put down a small percentage of the range of 5% to 25% of the total value, the total number of shares you're buying. For example, a share CFD with a stock CFD margin of 5% can gain you an exposure up to 20 times in comparison to the equivalent deposit capital if invested directly into shares. And remember, Santa Claus usually visits Wall Street right after Christmas, right before Christmas, and right after Christmas. So, from Avexo, we want to wish you a very happy and healthy holiday season, no matter what holiday you celebrate, or if you don't celebrate any holidays. It's a season to enjoy as we roll into next year. And we wish you all the best trading in next year also. So thank you very much for joining us. And I think we have one more webinar coming up this year. No, Seth is giving a couple webinars. So we still have more on our plate for you before the holiday season, before we close down for the holidays. So thank you very, very much. And we'll talk to you again real soon. And watch for Seth's webinar on Friday.